$40 billion. Emergency intervention. 2:17 a.m. Sunday morning. No announcement, no press release, no explanation, just the largest off-market emergency asset purchase in Federal Reserve history, executed while the world was sleeping. By the time Asian markets opened Monday morning, global panic had already begun. Not because of what the Federal Reserve bought, but because of what they were forced to buy, and why they had to buy it in complete darkness, bypassing every normal market mechanism, every regulatory process, every transparency requirement that governs central bank operations. Ladies and gentlemen, I need you to understand what happened in the early morning hours this weekend. What I'm about to tell you explains why markets opened Monday morning in complete chaos, why currency volatility spiked to levels not seen since 2008, why gold hit an all-time high while bond markets collapsed simultaneously across 3 continents. The Federal Reserve's emergency purchase wasn't Treasury bonds, it wasn't corporate debt, it wasn't mortgage securities or municipal bonds, or any of the traditional assets that central banks acquire during financial crises. The Federal Reserve spent $40 billion purchasing physical silver, gold, and platinum from commercial banks that were facing immediate insolvency due to commodity derivative positions. Think about what that means. The institution responsible for managing the world's primary reserve currency just admitted through their actions that paper money has become so unreliable that even the Federal Reserve needs to hold physical metals as emergency reserves. The central bank that prints dollars just declared, without words, that dollars are not sufficient to maintain financial stability. But here's the truly extraordinary part. The Federal Reserve didn't buy these metals through normal precious metals markets. They didn't purchase from mining companies, commodity dealers, or bullion banks. They bought directly from commercial banks that were liquidating their physical metal reserves to meet margin calls on derivative positions that had gone catastrophically wrong. Bank of America, Wells Fargo, JP Chase all quietly transferred their physical precious metals holdings to the Federal Reserve at 2:17 a.m. Sunday morning in exchange for newly created digital dollars. The banks needed cash immediately to prevent default on commodity futures positions. The Federal Reserve needed physical assets to back their currency as institutional confidence collapsed. The specific details of the bank's derivative crisis reveal the scale of reckless speculation that triggered this emergency intervention. Bank of America held short positions on over 200 million ounces of silver futures, betting that precious metals prices would decline as the Federal Reserve maintained tight monetary policy. When institutional dollar abandonment drove metals prices higher instead, their losses exceeded $18 billion within 72 hours. Wells Fargo's situation was even more precarious. They had written naked call options on gold futures, collecting premiums, while assuming that gold prices would remain stable below $200 per ounce. When gold gapped to $2,140 during Asian trading Sunday night, their unlimited liability exposure threatened to bankrupt the institution before American markets reopened. JP Chase faced the most complex crisis, with derivative positions spread across silver, gold, platinum, and copper futures markets simultaneously. Their quantitative trading algorithms had been programmed to short precious metals whenever dollar strength increased, but the algorithms couldn't account for the paradox of dollar weakness driving metals higher during a currency confidence crisis. Their automated trading systems amplified losses by continuously adding to losing positions as prices moved against them. The emergency transaction revealed something that financial markets had been suspecting but couldn't prove. Major American banks had been using their physical precious metals reserves as collateral for massive speculative bets on commodity prices. When those bets moved against them, they faced a choice between defaulting on derivative obligations or selling their last reliable assets to the Federal Reserve. They chose to sell, and the Federal Reserve chose to buy because both institutions understood that the alternative was immediate systemic collapse of the American banking system. But by making this emergency purchase, the Federal Reserve accidentally confirmed to global markets that the dollar system is so unstable that even American central bankers don't trust paper assets anymore. The timing wasn't coincidental. This emergency intervention happened exactly 72 hours after the largest institutional investors in Europe and Asia announced their coordinated exodus from dollar-denominated assets. The Federal Reserve was forced to acquire physical metals because they understood that foreign institutional confidence in American monetary policy had crossed the point of no return. Global markets opened Monday morning to discover that the Federal Reserve had transformed from a central bank that manages paper money into a central bank that hoards physical commodities. Currency traders, bond investors, equity analysts, all trying to process the implications of America's central bank becoming a precious metals accumulator during a currency crisis. The operational mechanics of the Federal Reserve's emergency purchase reveal unprecedented coordination between American financial authorities. Treasury Secretary Janet Yellen personally authorized the transaction through emergency powers that bypassed normal congressional oversight. Federal Reserve Chair. Jerome Powell activated dormant legal authorities dating back to the 1930s that allow the central bank to purchase any assets necessary to maintain financial stability. The physical transfer of metals occurred through military logistics networks rather than commercial transport systems. U.S. Army units from Fort Knox provided armored vehicles and security personnel to move precious metals from commercial bank vaults in New York, Charlotte, and San Francisco to Federal Reserve facilities under cover of darkness. When central bank emergency interventions require military logistic support, the crisis has moved beyond financial markets into national security territory. Congressional leadership was briefed on the emergency intervention through classified notifications that revealed the scope of the banking system's derivative crisis. House Financial Services Committee members who received the briefings described the situation as the most serious threat to American financial stability since the Great Depression, but were prohibited from public discussion due to national security classifications. The immediate market response was exactly what you'd expect. Dollar strength collapsed as foreign exchange markets realized that Federal Reserve emergency metal purchases represented official acknowledgement of dollar system weakness. Government bond yields spiked as investors demanded higher interest rates to compensate for currency devaluation risk. But the most telling market reaction came from precious metals prices themselves. Gold, silver, and platinum all gapped higher at the Asian market open, not because of increased demand from investors, but because global markets suddenly understood that the Federal Reserve was competing with private buyers for limited supplies of physical metals. When central banks enter commodity markets as emergency buyers, they distort pricing mechanisms because central banks have unlimited capacity to create money but no price sensitivity regarding asset purchases. The Federal Reserve can pay any price for physical metals because they create the dollars used to purchase them. This creates a feedback loop that accelerates the monetary crisis the emergency intervention was supposed to solve. As the Federal Reserve bids up precious metals prices through emergency purchases, they validate investor concerns about currency instability, which drives more demand for physical assets, which requires more emergency Federal Reserve purchases at higher prices. European central banks watched the Federal Reserve's emergency metals acquisition with a mixture of concern and strategic calculation. European central bank officials understood immediately that if the Federal Reserve was hoarding physical assets during a currency crisis, European institutions needed to accelerate their own acquisition of non-paper reserves. The institutional investor response to the Federal Reserve's emergency metal purchases was swift and coordinated across multiple continents. The Norwegian government pension fund, managing over $1.4 trillion in assets, issued internal guidance within 6 hours of the announcement that all new investment flows should prioritize physical assets and commodity-producing infrastructure over traditional financial securities. The Canada Pension Plan Investment Board went further, announcing that they would liquidate $15 billion in U.S. Treasury bonds over the next 90 days to purchase agricultural land, mining operations, and energy infrastructure across North America. When Canada's largest pension fund starts treating American government bonds as inferior to physical assets, the Treasury market faces existential crisis. The most aggressive institutional response came from Middle Eastern sovereign wealth funds, which began coordinating purchases of precious metals mining companies rather than just physical metals themselves. The Abu Dhabi Investment Authority, Qatar Investment Authority, and Saudi Public Investment Fund collectively committed over $60 billion to acquiring controlling interests in gold and silver mining operations across Africa, South America, and Australia. European insurance companies, led by Allianz and AXA, started offering policyholders the option to convert traditional life insurance and annuity payments into precious metals-backed instruments. When insurance companies begin offering metal-backed policies instead of currency-denominated coverage, they're preparing their clients for monetary system breakdown. The Bank of England responded within 8 hours of the Federal Reserve's emergency purchase by authorizing British commercial banks to convert up to 20% of their Treasury bond holdings into physical precious metals through the London Metal Exchange. When the Bank of England gives commercial banks permission to dump government bonds for physical metals, the government bond market faces existential crisis. The Bank of Japan's response was even more dramatic. Japanese central bank officials announced that Japanese commercial banks could exchange unlimited quantities of U.S. Treasury bonds for physical gold and silver through the Tokyo Commodity Exchange. Japan effectively gave their banking system permission to abandon American government debt in favor of physical metal reserves. But the most sophisticated response came from the People's Bank of China, which used the Federal Reserve's emergency metal purchases as justification for accelerating their own physical asset settlement network. Chinese officials announced that the Federal Reserve's behavior proved that Western central banks had lost confidence in their own currencies and were transitioning toward physical asset backing. The $40 billion emergency purchase created a cascade of central bank competition for limited supplies of physical precious metals. Every major central bank suddenly faced pressure to acquire physical assets before other central banks cornered available supplies. The Federal Reserve's emergency intervention triggered a global central bank run on physical commodity markets. Commercial banks found themselves caught in an impossible position. They needed physical precious metals to meet central bank requirements and regulatory mandates, but they also needed to maintain liquidity to meet depositor demands and business lending obligations. The Federal Reserve's emergency purchase removed $40 billion worth of physical assets from commercial bank balance sheets, creating artificial scarcity that drove up prices for remaining supplies. The insurance industry faced immediate crisis as precious metals price volatility threatened the mathematical foundations of actuarial science. Insurance companies depend on stable asset valuations to match long-term liabilities with appropriate reserves. When central banks start competing for physical assets and driving commodity prices into uncharted territory, insurance mathematics break down completely. Pension funds experienced similar mathematical crises as precious metals, price volatility, invalidated decades of portfolio theory based on stable relationships between different asset classes. Pension fund managers who built retirement strategies around predictable correlations between stocks, bonds, and commodities discovered that central bank intervention in physical markets had destroyed traditional financial relationships. The most profound impact was on ordinary Americans who had built their financial lives around the assumption that dollars represented stable purchasing power. The Federal Reserve's emergency acquisition of physical metals sent a clear signal that even America's central bank was hedging against dollar devaluation. Consumer behavior began shifting immediately as news of the Federal Reserve's emergency metal purchases spread through social media and alternative financial news sources. Credit card spending on luxury goods and services declined sharply as consumers prioritized essential purchases and began seeking ways to convert paper wealth into physical assets. Real estate markets experienced unprecedented volatility as both buyers and sellers struggled to price properties in an environment where the central bank was actively acquiring physical alternatives to paper money. When the Federal Reserve demonstrates preference for physical assets over paper assets, every price relationship in the economy becomes suspect. The cryptocurrency markets exploded higher as digital asset investors interpreted the Federal Reserve's metal purchases as validation of their thesis that fiat currencies were becoming unreliable stores of value. Bitcoin, Ethereum, and other major cryptocurrencies experienced massive inflows from institutional investors seeking alternatives to traditional monetary systems. But the most disturbing market reaction came from the Treasury bond market itself. Foreign institutional investors began dumping American government bonds at unprecedented rates, not because they feared credit default, but because they understood that the Federal Reserve's emergency metal purchases represented official acknowledgement that Treasury bonds were no longer the safest assets in the global financial system. The $40 billion emergency intervention was supposed to stabilize the American financial system by providing commercial banks with the liquidity they needed to meet derivative obligations. Instead, it triggered global recognition that the dollar system had become so unstable that even Federal Reserve officials were abandoning paper assets in favor of physical alternatives. The Biden administration's response to the Federal Reserve's emergency metal purchases revealed the political implications of central bank loss of confidence in American currency. White House officials initially attempted to suppress media coverage of the intervention, citing national security concerns and market stability risks. Press secretary briefings avoided questions about Federal Reserve metal purchases, while Treasury Department communications emphasized routine portfolio adjustments rather than emergency interventions. Congressional Republicans seized on the Federal Reserve's physical asset purchases as evidence of Democratic monetary policy failures, demanding hearings on why America's central bank needed to hoard metals like a survivalist compound. Senator Ted Cruz called for Jerome Powell's resignation, stating that when the Federal Reserve starts acting like doomsday preppers, American families should be terrified about what they know that we don't. Democratic congressional leadership faced an impossible political situation. They couldn't defend the Federal Reserve's emergency metal purchases without acknowledging that the dollar system was unstable, but they couldn't criticize the intervention without taking responsibility for allowing the banking system's derivative crisis to develop under their oversight. The most telling political response came from state-level officials who began implementing emergency financial measures independently of federal coordination. Texas Governor Greg Abbott announced that the state would begin accepting gold and silver for tax payments, while Florida Governor Ron DeSantis signed emergency legislation, allowing state pension funds to convert unlimited portions of their holdings into physical precious metals. International trade relationships began adapting immediately to the new reality of central bank competition for physical assets. Countries with significant precious metals mining operations started negotiating bilateral trade agreements that bypassed traditional currency arrangements in favor of direct metal exchanges. The geopolitical implications were staggering. America's closest allies watched the Federal Reserve's emergency metal purchases and began questioning whether maintaining alliance relationships was worth the economic cost of exposure to an unstable dollar system. When your most important ally's central bank starts hoarding physical assets during a currency crisis, political relationships become secondary to economic survival. Military alliance structures faced unprecedented strain as allied nations realized that American financial instability could threaten their own economic security. NATO member countries began exploring alternative security arrangements that didn't require maintaining large dollar reserves or extensive exposure to American financial markets. The most troubling aspect of the Federal Reserve's emergency intervention was its admission of defeat in the battle between physical assets and paper promises. For over 50 years, American monetary policy had been based on the assumption that paper dollars backed by government promises were sufficient to maintain global financial stability. The $40 billion emergency purchase represented formal acknowledgement that physical assets were more reliable than paper promises, even when those paper promises were backed by the full faith and credit of the United States government. The Federal Reserve just announced, through their actions, that the monetary experiment that began in 1971 had failed. Global markets panicked not because of what the Federal Reserve bought, but because of what their purchase revealed about the true state of American monetary policy. When the institution responsible for managing the world's primary reserve currency needs emergency access to physical assets to maintain financial stability, the reserve currency system has already collapsed. The emergency intervention was supposed to buy time for American policymakers to develop comprehensive solutions to mounting monetary system pressures. Instead, it accelerated global recognition that American monetary leadership was ending, and that alternative systems based on physical assets rather than paper promises were becoming operational necessities. The $40 billion was just the beginning. Federal Reserve officials understand they will need to acquire vastly larger quantities of physical assets as institutional confidence in paper money continues deteriorating. But every emergency purchase validates global concerns about dollar stability and accelerates the transition toward post-dollar monetary arrangements. The real reason markets panicked overnight wasn't the size of the Federal Reserve's emergency intervention. It was the recognition that the Federal Reserve had joined the global flight from paper assets to physical alternatives. When America's central bank starts hoarding metals like a doomsday prepper, the dollar system has officially entered its final phase. The emergency move has been made, the panic has begun. The transition is now unstoppable,